This is Rob Rowan with CFA Society New York. Welcome to our podcast, Compound Insights. I'm really interested in this topic today. We're talking about private deals in Africa. The continent's economies are being heavily pressured by the pandemic. Thus, for some investors, the search for value is on. So today we have two speakers. Emmanuel Essejaghi is the managing director of Vera Daniel & Company. It's a private investment advisory firm which covers unlisted investments in Africa. Previously, he was with Merrill Lynch and Riderwood Group. He has a BSc in finance from Rutgers University and an MA in economics, also from Rutgers University. Now, Saad Sheikh joined TLG Capital in 2014. His roles include originating, running the deal pipeline, structuring, and executing new deals. Saad also sits on the board of several of TLG's portfolio companies. Prior to TLG, Saad was a director at Accenture. So, gents, thank you. As I said, I'm real excited about this topic. I think this is going to be some interesting stuff for our members. I'd like to begin with your views of the macroeconomic issues that the economies in Africa are facing.
Excellent. Thank you, Rob. Thank you for having us here. I appreciate it. From a macro standpoint, the continent right now is going through presumably a contraction, which we'll definitely see in the numbers. It's typically the case that it trails the more developed countries and continent, which makes sense. So given that China has been a huge contributor to the continent and its development, as well as buying a lot of natural resources from the continent, it's expected to see that will be the case. And there's been also a lot of shutdowns that within the continent so far to limit the exposure and the spreading of the viruses. And unlike the strength in economies that the West has, where they're able to implement some serious fiscal stimulus to help its citizens weather some of the pressures that they will be having, the continent, it doesn't really see that quite a bit. So there's been a lot of some DFI measures that have been implemented to help with that case, and the private sector, especially the SMEs across the continent, have been asking the private sector investors, like the GPs who have come in and invested in them, to cover or meet some of the shortfalls that their respective governments failed to be able to meet with the fiscal stimulus. So, generally speaking, it's always to say that, when the U.S. sneezes, the rest of the world catches a cold, and that's very much so the case in Africa. And the granular pieces of how the economies are going to contract and how long those contractions are going to be are yet to be seen. But there's many ways that pie can be sliced, if I can use that word.
Of course. Saad, do you share those views?
Sure. Thanks a lot, Rob, and thanks for having me. I think it's a phenomenal topic. It's our bread and butter. So we're Africa-focused investors. We've been doing so for a number of years. And yes, we've not seen anything as catastrophic as what we're seeing with COVID-19. I mean, a number of you would recall the impact of the financial crisis, which then kind of trickled down into Africa, similar to what Emmanuel is alluding to a couple of years later. So 2008, 2009 were really bad for the Western markets, but 2011, 2012, going all the way down to 2016, you could see ripple effects all across Africa. It will be a similar scenario this time round, but what we're seeing is fundamental. Emmanuel's point is absolutely spot on. There's fiscal stimulus, both fiscal and monetary actually stimulus that is coming in the Western markets is quite substantial. The African economies do not have the strength of balance sheet to do that either on the monetary side or on the fiscal side. So central banks don't have that strong a deposit of foreign currency reserves, especially the greenback. They rely more so on forex from international investors, foreign portfolio investors, and DFIs/remittances. Now, all of that is slowing down, if not to a complete standstill at the moment. So that will definitely have an overbearing impact for a number of years. And it's important to see what the fiscal policy is as well. So as a number of countries are going into lockdown, some may think prematurely because the cases in Africa are less so, but something that and scientific studies show that is probably the right approach to do, given the dire straits that their healthcare system in most of Africa is. Now, let me not generalize because countries differ quite substantially all across the continent. But what I'm alluding to is the fact that the impact on the continent is broadly similar from the east to the west, just because of the dependence of their economies, either agrarian or commodity-led, or a function thereof. So these two things, either agrarian products or commodity products, have all been hit quite substantially. The world still sees a steady flow of agricultural products, but commodities, as you've seen with oil, have really taken a hit, and that's a function of supply and demand. Demands have whittled down to a trickle. Due to lockdowns, and supply has not stopped or reduced to the number that they should have, and now we're seeing an oil glut forming. What does that mean to economies like Nigeria, to Angola? Now, these economies are driven entirely by the oil prices. A fiscal budget for Nigeria assumes an oil price of between $55 to $65. That WTI price being at $25, you can imagine the fiscal impact that's going to have on the economy. They basically have a deficit of 50 to 60% in their budget. How is Nigeria as an economy trying to curb that? And to Emmanuel's point, they're reaching out to their friends outside of the continent, like the IMF, like the World Bank, to shore up some of that capital. But just to put the numbers into a little bit of perspective, Nigeria's foreign currency reserves were kind of dwindling around the $35 to $36 billion mark as at end of 2019. Those reserves have really taken a hit because Nigeria is supporting its currency with dollars, so not letting it free fall. With some seem to think it could be as far south as 500 naira to a dollar. It's currently pegged at about 380 to 390 naira a dollar. So not only is it supporting that, but also the government's income has completely shrunk due to lack of sale in the oil and gas space, or particularly the black gold. Mm-hmm. Now, it already trades the Nigerian oil trades to a slight discount to Brent. I think that has now widened, so it's about negative 4% to Brent. So Nigeria is selling its oil at about $10 a barrel, where WTI is trading at about 30 to 35. Brent is trading at 30 to 35. Now, this impact in the short term is going to be felt relatively less, but in the long term, if things don't bounce back, this is going to be a diabolical issue for them, almost an issue where Nigeria could default on its foreign obligations.
I just wanted to go back for 1 second and amplify something you just said, Saad. I appreciate the specificity of talking about Nigeria because it is the largest economy, it is the largest population, but there is a great variation amongst the economies of the continent, which we sort of glazed over at the beginning. So I just wanted to underscore that, support that.
Well, absolutely, and the idea here is what I'm trying to figure out for the viewers is going from a basket case in Africa led by oil to an economy like Kenya, which is relatively versatile, and where's this impact relatively better, right? So maybe I can come out of Nigeria for a minute and just kind of span across a little bit. So lockdown has not helped any of the economies, that's for sure. And that's true for Western economies as well. So Uganda went into full lockdown for about 3.5 weeks and is continuing to do so. Kenya, on the other hand, has been slightly lighter touch. So they put a curfew in from dusk to dawn, with the idea being that they wanted to limit cross-border or state border restrictions, but within Nairobi and within the main cities, they've kind of left things almost as business as usual, other than the curfew, but obviously adding certain features to it, such as social distancing. Now, what that has done is that's been a very, in my view, a fairly sensible approach, because the economy fares rather well in that scenario compared to more draconian lockdowns such as Uganda,
Nigeria,
Rwanda, Nigeria, South Africa. They're more draconian, whereas Kenya has been a little bit more light touch. Now, deaths in Kenya have been 11 from COVID, and to enforce COVID, police have killed, unfortunately, 12 people. So it's for you guys to think about the issues that stem from the country. But another number that we should think about is over 300,000 people die from malaria, and malaria type of diseases in the East African region. And the reason we know that is we're invested in a company that manufactures anti-malarial drugs. So to have such draconian strategies for an economy like Nigeria, South Africa, Kenya, can spell bigger concerns than just coming out of lockdown and how to re-engage the economy. It can be more fundamental and more infrastructure-led issues that can then come out. Some can go into a rioting situation, which obviously none of us want to see. But again, spanning a little bit further westwards and looking at Ghana, for example, which came out of lockdown about a week ago and is almost running business as usual. Again, we've got investments there, so we get a very close view on what's happening. I think all of these economies are reaching out to their friends in the Western markets who have their own issues to deal with. I mean, we've seen the largest amount of fiscal stimulus coming out of the U.S. In history. So U.S. has its own problems. European Union has its own problems. The key question is, how much can they really help economies on the continent? So a lot of work has to be done by these economies themselves.
Right. That is the one of the issues that I know a lot of people have been talking about are the number of countries that went to the IMF, which was broke a record, and leaves a lot of uncertainty in the markets. But perhaps we could stay with the trend, the road you were just going down there, was to the impact on the private companies that you all have a view of. I'm really interested because of their private companies. They're not beholden to other shareholders or bondholders, or some of them are bondholders, but they're not quite as beholden to the overall market. Do they have an anchor to windward?
Absolutely, in my opinion. While the road will definitely be a rough one, it will. There is a path forward. Our work gives us perspective on all of the GPs that work within the continent. There's been a lot of discussion about the structure and the nature of their fund moving forward and their relationships with the LPs as well as with their investee companies. Now, one of the general questions that's come about is the fund life, for example, and the structures there. And even having this be an opportunity to employ or in fact execute some of the strategies that have been talked about in the past but hasn't really been executed in regards to getting maybe more pensions involved at this point in time, asset prices and perhaps getting lower. We were speaking to one GP last week who mentioned that they talking to their portfolio companies and advising them to take on capital so that their balance sheet can be stronger to be able to weather any shortfalls in revenue streams coming in. And the concern for the portfolio company is giving up equity. So they are forced, in fact, to come in and deliver other alternative structures that will be able to help support the portfolio businesses, which in fact helps the return on the GP side, but as well making sure that they are able to participate and help stave off any issues that may be coming in. One of those is maybe developing a product for pensions that would actually meet local, not local currency denominated investments that pensions could perhaps tap into at that point. I'm not sure if SAD has seen or considered anything they're doing on that end.
No, absolutely, Emmanuel. So some very good points that you've made about strengthening the balance sheet. I think that's been the key message that we've passed on to our portfolio companies as well. But there's always a trade-off. How do you strengthen your balance sheet? And you alluded to that, where either you give off equity or you borrow. So there's definitely that conversation. So let me take a step back and just talk about the market as the private companies see it. So a foreign investor, when they go in, they price a product or price their return compared to or as a premium to the sovereign pricing. So sovereign debt has skyrocketed, or the yields on sovereign debt in Africa has skyrocketed. Yeah. So you'll find Nigerian T-bills trading at 13%, or Eurobonds, trading at 13%. Ghanaians Eurobonds trading at 12% or 11.5%. Kenyans have skyrocketed from 6 to 9 to close to 10%. So even Rwanda, which it was unknown to them, a number beyond 5%, they're at 8%. Right. So that's the backdrop that the local market or the private companies in Africa see. So a foreign investor, when it comes in, they'll be like, okay, this is the yield that I want. It has to be north of sovereign risk, because obviously I'm taking more risk. Mm-hmm. So that's the backdrop. So that's never a good scenario for the portfolio companies or for private companies on the continent. That said, let's look at the downside and the upside for private companies. I'm still an investor in about 14 companies on the continent, and my last 2.5 months, I think that's been about that time, has been focused on trying to figure out how my portfolio is going to perform on an ongoing basis. And just for background, I do both equity and debt with equity upside. So my idea is equity is illiquid in Africa. So how can I provide capital or growth capital to businesses and yet maintain the equity premium that I'd like to get out of investing in Africa? So with that mindset, the first thing that we went to our portfolio companies and figured out was their existing cash flows, given a disastrous situation on the revenue side. So projections that we did was, if COVID prolonged up until December, what is the impact on your cash flows? Some businesses were impacted to the extent that they had zero revenue during lockdown period, and a couple of them are digital media advertising, but some of them performed really well. And the ones that performed really well are healthcare, pharmaceutical manufacturers, pharmacy retailers, etc. They did really well. Middle of the spectrum, we have things like fuel retail, we've got banks and financial institutions, and microfinance. So they're neither zero revenue nor are they doing phenomenally well. So that's how I see my portfolio. What I've had discussions with my portfolio moving forward is, once you've projected your cash flow, then you know exactly what you need to do, which Emmanuel was alluding to. Either shore up cash through an equity raise, which is near impossible in this time, or borrow on existing lines. So nobody is going to give debt to businesses right now unless they have existing lines. So there's an absolute dried up capital base that these companies can tap into. So we've got the added advantage for businesses that we're invested in, that we can double down if we believe in that business to provide them more capital if need be. There is a business where we are doing that, and that is Nigeria. Given the macro, but we do believe in the story on the ground, because it's pharmacy retail for the base of the pyramid. Now that is the segment of society that is the most impacted, and we see that bouncing back the quickest. The pharmacies remain open, obviously, during the COVID environment. So these companies or these pharmacy retail units have actually seen a growth in revenue. So what we're trying to do is try to figure out or leverage the market, which and what I mean by saying that is, if you want to expand into a brick and mortar, you need to buy or take on greenfield assets and build on that. Right now, the best thing that you can do is take on cheap assets because it's not a seller's market. So you can name your price and get what you need. So we're taking advantage of that. We're taking up assets and building out a bigger portfolio for our pharmacy retail. We've increased on our pharmacy manufacturing business. We've increased production because we manufacture antiretrovirals and antimalarials. You've heard President Trump tooting around the chloroquine drug, which we manufacture in Uganda. There's no proof that it helps, but at least it's an anti-malaria, antiretroviral. What we do have is the ability to source ARVs and products that can manufacture an anti or a treatment drug for COVID if it comes out soon. Okay. Now, several treatments are being put into the fore, and we're thinking how to leverage our portfolio company to do that. Our fuel retail company has dropped down revenue to about 50%. What we've helped our portfolio companies with as well is grants and rapid COVID response facilities that DFIs have available. So we've tapped CDC, we've tapped the Swedish government who is invested in TLG, and we've taken technical assistance for them to companies on the ground to save their cash from being used for things like sanitizers, face masks, and the likes. And what we've done is we've leveraged that capital and put it to use, still keeping our people on the ground safe, but still, keeping cash safe as well. So those are things that we've done. We're still active on the continent. Let me add that to the foray, because we don't think that these issues are systemic and they're going to be for the long term. Yes, economies will get impacted, but for the most part, it should be coming back by the end of this year or early next year, which means the opportunity is now to tap into key players, key opportunities, which may have been a bit further out of reach and now fall within reach from a pricing point of view, from a risk point of view, from a strategic angle for us. So we've not stopped our origination elements. We're still talking to people on the ground. The only thing, unfortunately, that has happened is we can't be on the ground as much as we would like to. So where I would be on the ground right now, I'm having to sit at my desk in London and have a conversation with my portfolio companies or their contacts or further contacts of mine. So that's right. I think that's what I see on the ground.
Right. So due diligence is more difficult, but so Emmanuel, do you share the same view of the potential for the recovery and how the deal flow is moving now in your view?
That's actually a very good point. In fact, Sad mentioned some of the TA opportunities that they're getting from some of their portfolio, from some of their LPs. And maybe at a later time, I'd like to see some of the conversation they're having with their non-DFI LPs, although DFI has been a great supporter of, in fact, to put it broadly, there would be no no private equity. The private equity market across Africa has really been supported by the GPs, but to the extent that there are other degrees of LPs or the type of LPs that can come into funds and gain from what the progress that's happened across the continent, I'd like to see where their thoughts are when the likes of TLG are talking to their other types of LPs. But to your other question, to address your question more directly about the course for recovery, I do think that, the one thing is for sure, it's a great thing that unless there's a trailing of the virus and the significance of its impact on the continent, we are seeing that its impact with regards to everywhere else in the world is not just about the same on the continent. So that gives it a little bit of it gives the continent a little bit more of a hope in recovery. Something else as well is that some of the dangers within, say, the more developed markets is the leverage, the debt levels that a lot of the companies within the established markets have. And, default is a real concern in the event that these economies continue to be shut down and their balance sheets continue to be overburdened by those debts. Across the continent, by and large, the debt levels within these companies are not that much comparatively. So while, in some regards, that has been a critique, the fact that, capitalizing opportunities aren't readily available for businesses across the continent, that has in fact been a good thing for businesses within Africa at this moment. So for them to be able to now come out of these situations, that becomes a question of consumer ability to be able to, one, afford, right? And that is a function of them being able to earn and their businesses being able to maintain their operations and things of that nature. But from what we've heard from SAD so far, there's been a really great work done by GPs and their portfolio businesses that they're supporting to shore them up with enough capital to make sure that, one, they maintain the employees that they do have, and that they perhaps are able to pivot their operational structure towards whatever new structure that might be, i.e., a business that perhaps didn't have much online presence may start doing so. I was reading up on one such business, again, sadly, it's in Nigeria. It's a luxury good business, but in the event of the shutdown, they haven't had much of any foot traffic into the stores, which makes sense. But they have been seeing some orders coming in from the Europe and the US. If their online infrastructure was more bolstered up, which is what they're now working on through the help of their investors, they will be able to increase that. So there is hope that perhaps the dip in the economies within the continent wouldn't be, and this is sans commodities. Yeah, if we're looking at the oil-led economies like Angola and Nigeria, those economies will definitely go through some pain points, but that could provide a new opportunity for them to seriously increase the level of development and diversification within their economies, which can be a good thing as well. So I am generally optimistic about the direction of perhaps where COVID situation can push. Another such one that maybe we haven't touched on has been some social issues, because at the end of the day, the folks that are really affected by these shutdowns of the such are the really poor across the continent. And these are the market sellers, the folks that have their little shops around the corners. Those folks are truly going through a hard time at the moment. And if shutdowns are to be extended and the economies are hard to regenerate, some cash flows that will reach them, there is somewhat of a risk of social uprisings. But again, this provides an opportunity for individual countries and economies and their governments to be able to up the ESG, if you will, ESG effects in making sure that there is a robust plan that goes into upward mobility for its citizens. And all that, in my opinion, gives me a great deal of hope for the continent. I think the continent will rise to that challenge. And I do think that coming out of, I've heard economists mention that this will probably be a U-shaped recovery. And I do imagine that would probably be the same case for the continent, that coming out of this, we would see much more robust economies across the continent.
Well, you make a good point about the potential for social pressures. And that is, of course, local. In some countries, more severe than others. But this is really interesting, guys. I did hear you say a couple of things in there that should be interesting to a lot of the members, including the relatively low amounts of debt that these companies are carrying. That could be very interesting for them. So, well, perhaps we should leave it there. But thank you. This has been a fascinating look across a very wide and broad, diverse area. So.
Yes, the conversation continues, certainly.
So I hope all of you have enjoyed this episode of Compound Insights. You can subscribe to this podcast on the app of your choice and hear podcast details on our website at cfany.org. Until next time, I'm Rob Rowan.